So what are your thoughts on the latest CPI print? Like, do you still see this as just a bounce on the way down to 2%, or is this a problem?
I think right now we're still in an area that we can consider safe in terms of disinflation. Obviously, there has not been any disinflation in the last 4 or 5 months, but I think that is to be expected. Miraculously enough, right? Like the disinflation, the trend disinflation slows pretty significantly as you know the the elections come up, Donald Trump becomes president, or the odds of Trump becoming president rise, right? Like we pretty much bottom out when he becomes like when after Biden drops out and everyone realizes that he's got a real shot at winning, and then we go into the election, he wins, and inflation's just going up from there. And I think there's a lot of outside forces in inflation outside of the typical, longer term drivers. Number one being I think we're seeing a lot of push and pull of people trying to get goods into America and resources back into America before they have to suffer the consequences of any tariffs. And we spoke about that a bunch now. And ultimately, it looks inflationary, right? Like tariffs. Oh, look, Trump becomes president. Trump talks about tariffs. Inflation goes from what's it, 2.5, 2.4, so 2.4% up to 3%. Tariffs are bad. Tariffs are inflationary, right? That's what the idea is. But I don't think that's ultimately true. I think that, yeah, like if you're going to put a lot of pressure up front, right? If you're going to try and front load a lot of demand and the supply is not shifting, right? You're going to push prices up.
Yeah.
But it's going to be short lived, right? Because the reasons for why these prices are going up are not inflationary reasons by money in terms of money, right? They're inflationary due to demand and the time being trying to meet a deadline. And I think that that's where we're starting to see like some some things like just show, a look at CPI, right? Egg prices are up quite significantly, right?
Yeah. Like,
And
is this something that could cause the Fed to stay overly restrictive for too long?
yeah, like okay, so I think in some ways yes, because you look at it from the Fed's perspective. Like let's play a double-edged sword. Let's look at it from the Fed's perspective, and the Fed has to look at it from like everyone else's perspective. The Fed's independent, right? But the perception of inflation is also derived based on how everyone's looking at it. So the Fed has to somewhat have an objective view of how like the rest of the country or the rest of the population is looking at inflation.
Yeah. And I did
And
see a study. There's majority of Democratic voters believe that inflation's going to increase, whereas Republicans didn't. So I wonder if
yeah, of
that's kind
course.
of what we're seeing right now is that self-fulfilling prophecy of a lot of people expecting higher inflation under this administration.
I think that's like again, the inflation expectations are a little bit detached here because you need to understand from the perspective that these prices are up already. This is less to do it. Those are more longer term. I know what you're talking about. You're talking about like the college studies on and the surveying of
Yeah.
political parties and the studies and how they're distorting the and forward expectations of inflation based on who the president is at the time. And those things are always skewed for sure. It's politics. Like it's people think if their party's in control, everything's going to be okay, and the opposite party thinks it's going to go to hell, right? So that's just normal. I think when we look at it from a perspective of what's going on here in terms of actual progress, like just look at commodities, right? Like let's take a look at commodities. If you really tone down the chart and just zoom out, commodities are at the upper end of their range, right? Of the last 2 years or almost 3 years, which makes sense, right? The recent surge right after the summer, like we saw inflation go up. Commodities are up since September. Inflation is too. Makes sense. But now what you're noticing here is like we're not having that follow through. So like if I was looking at this from a perspective like you asked me earlier, right? Like where at what point do we think that disinflation is over and we have to start worrying about inflation again. And I would say it's quite simple. Anything above 22 on GSG is worrisome, but unless we're over like the highs of this year, if commodities are not making new highs on this year, I wouldn't be too concerned.
Yeah.
Like if they're not breaking out further than they already have, like if this 2023 high holds, I would pretty much say that we've kind of put a cap on the inflationary pressures to the upside. But we also have an inflation index and a growth index. So we're going to obviously rely on the inflation index for more insight than just commodity prices here. But ultimately, yeah, I don't think inflation is a problem at the moment. I know this week we had a CPI print that caught a lot of people off guard, but we were 10 basis points over from the forecast where 2.9 came in at 3. So it's a bit hot, but I think that what I was saying earlier with the tariffs, we're running out of time. I think we're burning the fumes out of the tank there. At some point, we're gonna do a reversion of of what I see right now as like a push for a push on inflationary pressures due to basically a supply crunch, people moving things around, specifically import exports, right? And as that fades, I do think that we get some more clarity on the tariff plans. I think that inflation will settle back down and continue its disinflationary trend because, again, the biggest issue in the inflation basket right now is services, things like rents, and I don't think that we have to be worried too much about tariffs on rents.
Yeah.
Right. So I think rents, if the Fed is in fact, like if we look at um, the breakdown of inflation on a service basis, you'll see that disinflation has been pretty much consistent. And it actually slowed in services, but it hasn't really materially accelerated. So again, we just need disinflation to reemerge there and to consider to just a moderate degree. I wouldn't even say like considerable. And then there again, we will have a continued path of disinflation.
Yeah. I mean, bonds are still slightly elevated, slowly grinding up towards Momo. So I think even bonds agree with that this isn't too big of an issue and we're still more or less on a disinflationary path.
I always say this, right? Like if you're worried about inflation, if inflation fears were really going to accelerate and people were really like balls to the wall scared, bonds would be above below the 24 low. We on a I mean we could just go back on a non-dividend adjusted basis, but like on a total return basis, on a non-total return basis, excuse me. So this is not accounting for what you've received in dividends. Bonds are still above the 24 low. Like, just think about this. If inflation is significantly worse for bonds, where we're like where we are right now, and people are really scared, no one would be buying duration. Instead, like we're starting to see like this weird semi uptrend here in bonds. Hopefully, it continues, but um, not quite there just yet, right? And like a broader view would be just look at the long end. Like let's just say we're worried about inflation. Why is the long end not over 5? Why is the 30-year not over 5? Like like you have to ask yourself these questions. Could we get there? Sure. But like right this second, like if we started breaking out, I'd say, okay, the market's really scared. But like right now, the market's not too afraid of inflation. So you look at the cues, right? We had the gap down yesterday on the CPI print, complete recovery, and grind higher today. So it's obvious the market shook off that inflation news as well. So I think there's bigger things at play here outside of just how hot or how cold the next CPI print's going to be, right?
Yeah, and there's just still so much up in the air. Like I'm curious how the tax cuts are gonna play a role in the inflation game. Like if Trump actually does get rid of the federal income tax, I see that as very inflationary and very strong for growth as well.
I think you're somewhat right on that. I don't want to disagree with you, but I do want to say that I don't think he's going to get the tax cuts that he wants passed without having some sort of offset. Number one being cutting the deficit to begin with, right? Doge and whatnot, but ultimately bringing that tariff revenue up.
Yeah.
He's not going to just so if you start from a blanket of bringing tariff revenue up, right? You're gonna so this goes back to the saying like when people say like, oh my god, tariffs, like everyone's gonna pay a higher price. Like it depends, and I want to keep this very simple. If you live in America and all you consume is Canadian maple syrup, okay, it's the only thing you consume, and a tariff is put on maple syrup, it is going to dramatically affect your life because it's the only thing you buy, it's the only thing you consume. Yes, the prices will shift on you. Will they go up every year at that rate? No. They may go up 20%, 50, whatever the tariff is, right? You'll eventually feel the burden of that tariff. But not everyone is living on just maple. Nobody's living on just maple syrup, right? You have other expenses. So what ends up happening, and you have the ability to buy competition. So what ends up happening with tariffs is there's this short-term shock with prices with whatever you're putting the tariff on. You shift the price around. Maybe if it's dishwashers, if it's maple syrup, if it's cars, right? And then people have to adjust. If they have an infinite access to capital, then theoretically tariffs are going to move prices up, but they're not going to slow anything down because people will just have infinite access to capital and they'll be able to continue spending at higher prices. But in reality, it's going to put a strain on demand at some point. And that demand is going to offset growth. So what's going to happen is you're going to have this initial inflation spike or shock. And I think we're kind of seeing that already in the CPI print. And in commodities and whatnot, that initial push of like, oh, prices are going up. There's a rush to basically get goods now before the prices even get affected by a tariff. And then once the tariffs actually happen, everyone has to absorb that demand shift, and that's going to slow growth. So I think that if you do this tariff plan the way Trump wants to do it, you kind of need the tax cuts because you need to offset the shift in demand, right? So you're going to basically hinder demand to the public sector by putting the tax cuts through. You're going to allow the public sector more access or additional access to capital, right? And at that point, they will be able to pay the higher prices and they'll be able to function as normal. And you're basically just shifting the revenue source from, you're still theoretically taxing the individual at the end, but you're just moving it from a person by person basis to a blanket basis on goods. That's what you're doing.
Yeah. I feel like he's not going to implement any removal of income tax for at least the next couple of years. I feel like the way he has to do it is he has to see, first of all, how much money they can save with Doge and anything else, and see how the tariffs play into effect and how much income they get from the tariffs. That's when they can start thinking about how much they can cut down on taxes. Can it even be fully removed, or can it just be a partial cut?
I think we're far, if not forever, away from like a full removal of the income tax. I don't think that's going to happen quickly.
I
If
don't
it
know.
ever, if it even does.
don't don't doubt Trump. He's the guy that would do it.
I don't know. I get what you're saying, but I think I like, let's put it to what you just said, right? He wants to see the playing field before he starts.
Yeah.
He puts the plays on the board, right? And I think that that's you kind of have some risk there if you think about it. I wouldn't say it's like detrimental, but think about it like this, right? He's going to wait and see how tariff impacts happen and whatnot, and how everything basically flows through the economy. And we know that the the larger amount of tariffs, or I should say the the more aggressive he is with tariffs without offsetting that, the individual side being, more access to, or additional access to capital, he's going to just slow growth. So in your scenario, I think that Trump ends up cooling down the economy and then realizing that we need the tax cuts. But anyway, I want to take it back to what we have been cooking here at Market Radar. I've been teasing this a bit, speaking about it. I'm not going to make any official releases but this podcast until it's done. So I want to kind of show everyone and specifically our members who watch our podcast what's coming for members at Market Radar. So for the members, you guys know that the quant deck, which is our daily report with all of our signals, models, and data that we publish daily, is basically our bread and butter. That's where you get your signals. That's where you get the instructions on how to trade or how our models work. And ultimately, that's archaic, right? Who wants to look at a PDF? So we've been working on a digital solution that members can access whenever they want and interact with on their own time. So what this is going to be called is QuantBase. And this is what it looks like. So this is an interactive model that connects to our backend data feed, which powers our quant deck. We're moving everything over to the cloud, and it's going to allow everyone to interact with our models on a personalized basis. You can track things that maybe you wish you could have tracked before and couldn't, and now you can see a lot more detail basically across every data point, everything that we have, in terms of, without sharing the proprietary functions themselves. You guys can see more detailed precision and specific insights to give you a better understanding of how our models work, and more importantly, test and figure out how they have performed at certain points over time, so you can feel or you can get a better understanding of what to expect when you see these things in real time. So you'll be able to query strategies, our strategies, put in time frames, see how have they performed, and see the statistics, and also what the positioning was at that time. And you'll get all of our other features that we have in the quant deck all available for you in interactive format. So we're hoping to launch this in the next couple of weeks at the most, but obviously this is, we're a 2-person team at Market Radar, so this has been a project and a half, to say the least. It's been very time intensive and exhausting. So if we're doing this, we're going to do it right. So if it does take us some time, we just want to make sure that it's the best it can be, and you guys can have the most fun with it when it's finally launched. And again, for now, everything is going to be still in the quant deck, but that is coming to an end quite soon. But if you guys enjoyed this podcast, please share with your friends. Thank you so much for listening, and we'll catch you next week.